Hi, this is Kim Watson. In this video, I want to show how it's possible to supercharge your trading returns. So let's get on with it. So firstly, when people start trading, everyone starts out to trade to make money, of course. Now, most people start off with some great expectations, particularly if you've been watching any of the ads of videos on YouTube that you see out there. But they have these great expectations. However, in reality, a lot of people do it for, they want, of course, to make money, but don't have such great expectations. Of course, many traders fall by the wayside on the way to making anything. In fact, if you read websites, brokers' sites, I should say, you'll see that around about 80% of most retail brokers' accounts are lose money trading CFDs. So, of course, this is the crux of this. Making higher returns equals higher risk. So you've got this sort of risk-return situation. If you really want to make something more than what you're going to get in a building society, which is probably best about nothing, you're going to risk something more to make that. So, and on the basis of that, you might not make it. What is realistic in terms of trading? Well, looking at some benchmarks out there, Barclays CTA index for last year, for example, the funds that were trading there averaged 5.42%. This year they're up 1.4%. Not setting the world alight there, are they really? And these are funds. This is the Superspot super funds based in this Australian bit of data actually. 8.6% 5-year return per year. 8.6%, of course, that over the 5 years is quite nice, but a lot of people will look at that on their account and think, this is much less than what I was expecting to be made. I was told I'd be doing that a day. So where does it really, what is reality, or what can you do with it? Well, the thing is, you've got to look at the strategy you're using to see what you can actually do, and if it's possible to do what it's claimed it can do. And when I'm developing a strategy, or in the case what I'm showing you here, I call it a growth strategy, because it's a real plodder, but it gives and takes. But it gradually grows over a period, and that's the important thing about trading, is that these things that might just sort of be a bit zippy and give you a great return 1 month, and it's because it's been curve fitted to the last 3 months, it may have a shelf life, whereas the sort of strategies we look at are long-term strategies, and strategies that you can test and have been tested over longer periods. So you need to find yourself a growth strategy. I've looked at, this is a strategy I'm calling my growth strategy for the want of a better name for it, really. In fact, I've got so many names that are so conflicting. I've decided I'll call it an intraday swing trade, or something along those lines. Anyway, it's the performance of a strategy. This is that I've been testing. I've been using for many years, stopped using it altogether, then looked at a different way of calculating the risk reward in terms of how to trade it and its potential, allowing more basis for variations in markets, and it's come out pretty well. Now, I've tested over 2020 here on a one-to-one. I mean, I did it on many different ratios. This is a one-to-one risk-reward ratio. It's very basic, and it's sort of for those people that don't like much in the way of risk. It's as I say, it's a bit of a plodder. It does have, of course, drawdowns, but it's a plodder. I've been trading it. Okay, admittedly, that was on. This is based on two currency pairs over the year, risking 1%. I've been trading it since January 2021, just on one currency pair, just on the euro dollar. It's up at the moment since the 15th of January, actually. It's around about 8 weeks, and it's up a modest 12.8% at the moment. So it's ticking along. That's all it needs to do, is tick along. Now, it's not going to be the best strategy out there before you say, oh, that's nothing, I can do that in a day. It's not meant to be. It's a plodder. It's something that you can put. It's an underlying strategy, if you like, that just ticks along and makes the bread. You can put the jam on it later, but it's one of those strategies that is, as I say, it just delivers steady results. So I've taken that strategy and looked, and I was been talking a lot in our trading room recently how you can accelerate the rewards. We talk about many things, but you can actually you know, compound what you're doing. Now we sort of in our trading room we don't talk in pounds per point or monetary figures in that term. So we talk about the risk, and you will look at risk, and we look at percentage risk of an account. So if we're looking at a trade, and particularly in this particular strategy I've talked about, it's a 1% risk each time. So, but if you carry on looking at, if you just traded a set amount on each trade, you're missing something, the power of compounding. If you take the power of compounding, it is absolutely amazing. If you start it on a young child's account and just keep on adding and adding and adding and compounding and taking risk and do it over a long period, it's amazing the outcome of it. I'll show you some results. I mean, you're looking at results of it anyway, but now what is compounding? Well, this is where you're basing, in this particular case, is where you're basing each trade on the amount in your account. So effectively, as your account gets bigger, so does your position and possible return or loss. And what I've done here is, look, I've just taken three little different parts of that last year, and taken it, started off, this was the very beginning, it had a winning trade, it made £10. It was 1% risk, £10 risked, £10 reward. It then lost, next trade, £10, because it was there at the risk going on that next trade. It was effectively £10 10p, and so it gave so it took off £10 10p. Next trade it won, made £10. Next trade £10 10p, next 10.20, 10.30, and so on. And as you go through, you can see it's about £13 about midway here, and towards the end here we're just looking pure running through. I'm just looking at a winning trade here would have been about £18 effectively. So it's gone from £10 to £18 in the matter of the year, just simply in this method. So in terms of this strategy, it actually netted 60% effectively, but when you've compounded it, taking it 1% a trade, if you've just literally taken the same amount each trade, you'd have been up 60% over that period on that account. Whereas if you're alternating, if you're increasing on each trade by the amount that you've got in there, so it's 1% all the time, so it's effectively compounding it. It was up over 80%. That's a 20% difference just on 1 year. Talk about supercharging, 20%. That's more, it's massive. Okay. So you're still only risking 1% of your trade on each account, so on each trade. So that's an important thing to cover there. So the trades build up quite well on their own in this strategy. It's a nice sort of steady builder, as I said, and it's building up over that time. So how do you then accelerate that build the strength of the compounding? For sure, it doesn't need to be done purely by trading. This is where you can top up your account. So you can actually add to your account each month. So let's take, you've started with £1,000, and let's just take that you've, that's what you're willing to start with, and that's how I've built this particular strategy. I've just said, right, let's start off with £1,000 in it, and then let's just add £100 a month to see what happens. And what you see is that you've invested over that period £2,200, but over that period with the compounding on those trades, because you've got a bigger trade each time, as you add the money, the amount that you're returning is bigger each time, so long as it's keeping a nice win-loss rate. Your account size is growing. On this particular example, it went from 1,000 to 3,200. Now, of course, you've put 2,200, and that's you've netted around about £1,000. Actually netted, in real terms, it actually netted £1,001 when on the calculations, versus if you just left the same amount of money and hadn't added, you'd have netted £800 on your capital. So you can see adding that extra capital in there is increasing the effective amount of money that you've got in your account now. So it's supercharging your account effectively, with each winning trade netting £32 at the end of the year versus £18 if you've just been, as I just showed you that, around about £18 on an account that hasn't had that extra £100 boost a month. So it's just showing how you can boost your account. So in summary, you just need a steady strategy, or your strategy needs to be consistent. Whatever you're doing, you've got to be consistent. It's a key role to trading. But if you've got a steady strategy, it's brilliant. Now, then you just need to be consistent yourself and put the same percentage in each trade. So your percentage, that doesn't mean to say you, or something that's got a 50-point stop that you're having to risk more than 50. You're only still risking 1% on any one trade. So it doesn't matter what the stop size is. You get less focused on position, the amount of points or some dollars or whatever it's going to make, and you start looking just at that risk, and your focus is, it's easier to trade. And if you top up each month to accelerate the building of your account, then you're going to be significantly better off. Now, I've only used one strategy here in this example. Of course, you may have multiple strategies and you can overlay them, but it's very difficult to put all strategies together and see what would be the result of that. I've just taken, as I say, that one strategy. Now, of course, you will have drawdowns. You see that from peak to peak here, you'll have drawdowns at times. The biggest drawdown on this particular strategy on a one-to-one basis was 8% over that year. So you see these peaks between, as it's pushed up, it pulls back, and it's dropped 8.7% at the worst peak, effectively, or worst case scenario over that year. So of course you're going to have drawdowns, and when you're having drawdowns, that is going to be a larger sum of money. But at the end of the day, if you're making this would be making, as I say, 1,800, but if you're doing 3,200 instead of that, that's a significant upstep. You can carry these drawdowns. As I said, I've only risked 1% on any of this. So look forward to your thoughts. As I said, it's a way of increasing those accounts, your accounts, potentially. And I say potentially, there's no absolute certainty, but potentially you could be increasing your account. As I said, the power of compounding and a top up. You may have rules in terms of your top ups that you will only top up if you have a winning month. Fine, whichever. One thing I would say is don't throw good money after bad. So if you're constantly losing and your strategy just isn't working, have a look at your strategy, what you're using. You need to really be looking at something that has proven results, proven track record in the current markets, and particularly check it, make sure that it's one of the things is it's not me, it's you. In other words, some people will be trading the same strategy, and of course they'll trade it slightly different, or they'll miss trades, or whatever it may be. You've got to be consistent all the way through there. And as I said, compounding and add-ons when you can. Look forward to your thoughts. If you don't already subscribe to our channel, do subscribe to our channel. If you're liking this, please give me a thumbs up. Many thanks. Take care. Bye for now.